Welcome to episode 2 of the bootcamp. Now we're going to be going over candlesticks. This is the first one where we're going to be looking at the charts for the first time and breaking down the absolute basics. So when you open up the chart, you're probably going to be met with candles that look like this, okay? Now, the green candle is a bullish candle, which is an up candle, which means price increased during this time. Now, up here is your time frame. So this is currently a 1 minute time frame. You can change it to whatever time frame you want. So each candle will be 2, 3, 5, 10, etc. minutes. You can have hours, months, weeks. So whatever time frame you select will be however long each candle represents. For a bullish candle, it will open at the bottom of the coloured box. So the bottom of the green box where it opens. So for example, this one opened at 28.90, which is represented over here on the right. And then during this 1 minute period, because we're on the 1 minute time frame, the candle went down here, up here, and closed there. Okay, it always closes where the box ends for an up candle. Now, the other things on the candles are these wicks, which I've marked out now. Now, these wicks are where the price went during the candle, but it didn't open or close there. The candle opened here, went down to here during the 1 minute that this candle was forming. So in a minute, price was doing this, okay? It closed there, but at some point it actually went up to here, but it closed there, okay? Do you understand? And it also went down to here, bounced back up, came down to here, bounced up to there. You get the point, okay? It's the exact same scenario with the down candle or the bearish candle. So the candle always follows on from the previous candle close. So here is where this candle closed, which means the next candle, so the next 1 minute of time, will open where this one closed, the exact same point, okay? And then the same story. So this candle opened here, at some point it went up to here, but then it also went down to here, and it eventually closed there, okay? Now, that is just the basics of the candles. That's how simple they are. All they do is tell us the price and how far it moved during a certain amount of time. So if you go on the 5 minute time frame, each one of these will be 5 minutes. And during that 5 minutes, price could have started here, dropped down to there, etc. You get the point. So that's pretty much the exact basics of each candle. There's nothing really more to a candle apart from it tells us where the price has been and where it's opened and where it's closed. And that is pretty much it. Now, the way that you can use these is to determine your trend. So if we go down into the real life chart now, you can see I've got the same example drawn out, but this is the real life market. So you can see that the price is actually in an uptrend from here. The candles are closing higher. The next one opens there, it closes higher, and it keeps going. So we're in an uptrend, okay? So in this scenario, you would be looking for a buy, of course, because the candles are in an uptrend. At this point here, we start coming down. You can see the candles are opening where the last one closed, and we are getting lower. Every single time we are getting lower in the market, and the price is dropping. So this is called, obviously, a downtrend. Now, that's why you're going to be looking for sells. Now, the way that these candles are formed is by orders. So what an order is an order into the market. So when people are placing buy and sell orders, so when they are trying to enter the market, that is what causes these candles to move. So if we look at the size of this candle, for example, this blue candle here, which I've circled, okay, you can see how large it is compared to the other candles. So this here is a volatile candle, which means a lot of buy orders were placed around this area, okay? Because for some reason we didn't want to go any lower. You can see we were coming down, and then here we pumped up. So that means that at this level, there is a lot of buy orders ready to be filled, and it eventually launched price up and give us a big volatile candle to the upside. That is the exact same scenario with the down candle. So here, for example, you can see we were pumping up, big candles, big volatile, up candles, and then here we had a wick. So this candle here went up to here and then eventually closed at this level, and we started to then retrace back down and form bearish candles and start seeing a downtrend. Now, again, this is where a lot of sell orders would have been placed. So people here are trying to sell the market to push it down from this price, which was 27.90. So that's the banks, the institutions, also all the traders, but in the masses do not like price coming above this zone. So for whatever reason, people are entering short and trying to sell off Nasdaq in this scenario. Now, also, what we can read from candles is trends, like I said earlier. So the way you can read the trend from the candles is looking at the pattern that they kind of leave behind. Now, you should be noticing that when we're in an uptrend, you can see that price doesn't just move in a straight line. Okay, the markets don't just do this when they go up, and they don't just do this when they go down. Okay, they move in a certain pattern. Now, that pattern happens every single time, and that's just how the markets move. So in this uptrend, for example, over here, you can see price starts plummeting down, we get a big wick, and then for some reason again, there is a lot of buy orders resting in the market here. So we want to pump price up, and you can see we get a big volatile candle, and then we start forming an uptrend pattern, which consists of higher highs and higher lows. Now what that means is, this out, okay, so we have a higher high and higher low. And what that means is exactly what it says on the tin, okay? This one here, this high is higher than this high, okay? So this high here, you've got this one here. So it's a higher high, which means we're in an uptrend. If you think you've got a high here, then if the next one goes there, then it's higher than this one. It's a higher high. Pretty simple, okay? Now, the same scenario for the higher lows. So the reason we know we're in an uptrend is because we're creating higher highs and higher lows. This low is higher than this low. There's a low, there's a low, there's a low. You get the point, okay? And all of these are higher than the previous low, which means we're in an uptrend. Now, of course, the exact same scenario in a downtrend, we're going to be creating lower lows and lower highs. Okay, so you can see in the market we have got a high, a low, a lower high, a lower low, lower high, lower low, and then here we change trend again. So we start creating high, low, higher high. You get the point, okay? So that's just the way that we establish the trends, based on higher highs and higher lows. Now, these are obviously all formed by the candlesticks, and we can simply establish the trend just by looking at the chart. That doesn't require any experience or any kind of expertise. If you simply just look at the chart, you should be able to tell me, are we in an uptrend or are we in a downtrend, based off that screen. So that's going to be it for episode 2. On episode 3, we're going to talk about chart patterns and understanding a bit more in depth